This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
Okay, number 11. Which of the above are examples of direct data capture costs? Direct data capture is where the data goes straight into the computer. Nobody's got to type it in or process it. It can go straight into the system. So run down the number 1. The use of barcoding and scanners, yes, that is direct data capture. Simply scan the object or whatever it is, and the information, the data rather, goes straight in. Number 2, no. Payroll department's processing of personnel costs. It's not going straight in. Somebody's had to process it before the data can go through to management information, so it's not 2. Number 3, completion of timesheets by employees. It can be. I mean, tiny bit unfair. But if the employee fills in a timesheet and that can then be directly entered, it can be scanned. Direct data entry, as opposed to somebody in the middle having to type it in and it be processed that way. So 1 and 3, which is C. Number 12. Another statement one, effectively. Which price strategy is the company using in each market? And you can see there the choices. It's penetration pricing, price skimming, price discrimination. They're all gone through in the notes and in the lectures, so it really is very much learning what they are. But let's have a look and decide. A company has entered 2 different markets, new markets. In market A, it is initially charging low prices so as to gain rapid market share while demand is relatively elastic. Well, charging low prices to gain market share is penetration pricing. And in fact, although I'll read about market B, look at the choices of answers. We already know the answer has to be A, because it's the only one that has penetration pricing in market A. So if you're confident of that, because if you've read it, you should know it can't possibly be price discrimination and price skimming. So if you're confident, that's well, you could save a few seconds of time, and every second matters. However, I will read market B. In market B, they're initially charging high prices to earn maximum profits while demand is relatively inelastic. Well, that is price skimming. So it's very much a definition question. If you've read the notes and watched the lectures and you remember, that's easy, straight off. If you haven't, then I'm afraid it's a guess, but you may as well just guess. Staring at it won't make you remember if it's something you've never learned. Anyway, it's penetration pricing, price skimming. So as I said before, the answer is A. Number 13. Back to a sort of numbers one. Look at the requirements. Which of the following objective functions and constraint statements relating to material and labour respectively is correct? Well, it should hit you immediately. It's linear programming, not an extract from it. And let's look back. Highfly manufactures 2 products, X and Y. Any quantities produced can be sold for 60 a unit and 25 a unit. We're given the variable costs of the 2 products. I won't read down them yet. Next month, only 4,200 kilos of material, 3,000 labour hours will be available. There are constraints. We aim to maximise the profits each month, and we're going to use linear programming. And in the equations, remember you can use any symbols you want, but here they tell you X will be the number of units of product X and Y, number of units of product Y. Well, it doesn't matter which order you look at these in. Excuse me. I'll look at the objective first, and the objective, remember, always is to maximise contribution. If we maximise contribution, we automatically maximise profits. So what would be the total contribution? Product X, the selling price is 60. The variable cost is 45. So the contribution is 15 per unit. Product Y, selling price 25 on the first line, variable cost 13. So the contribution 12 per unit. So the total contribution, we're making x-axis, so in total 15 times x. In addition, y-y's, so in total 12y. There is the objective. So we immediately narrowed it down. The answer, it has to be B or C. But of course we need to get the other bits as well. So let's start looking at the constraints. First of all, materials. We're limited with only 4,200 kilos available. How much material does product X need? Per unit? Well, we're charging $15, it's $5 a kilo. So it'd be 3 kilos for each unit of X, and similarly for product Y. $5 in total, it's $5 a kilo, so 1 kilo for product Y. So in total, how much materials do we need? X units of X at 3 kilos each, so a total of 3X kilos. In addition to make Y, 1 kilo for every Y, so in total Y. So 3x plus y is what we'll need. We're limited to 4,200. It must be less than or equal to 4,200. And so, where are we? Yes, I said it was B or C. B, we've got materials 3x plus y greater than or equal to 4,2. That's wrong. It's the second one, 3x plus y is less than 4,2. So in fact, we now know the answer is C. I will go through the labour constraint, but don't waste time in the exam. You've got to keep moving. You can always, if you've got time left at the end, then you can come back and check, do extra things. However, for completeness, I will do labour. How much does each unit use? X, it says $24 for labour, but it's $6 an hour. So it must mean that's using 4 hours of labour. Product Y, $3 a unit, $6 an hour. Y is using half an hour. And so with X units of X and Y of Y, for X, a total of 4X. In addition for Y, 0.5Y, less than or equal to the total available of 3,000. There is the labour constraint. And let's check it does work. For C, we already said it had to be C, but if you look at the labour constraint, yes, there we are, 4X plus 0.5Y is less than 3,000. I've confirmed I was right. Okay, which number was that? Number 13. Number 14. Which of the above does the manager have control over in an investment centre? Now, yet again, it's all in the notes, and so this should be fairly automatic. But number 1, generation of revenues. Yes. Number 2, investment in non-current assets. Yes, that's why it's an investment centre. That they have authority to make decisions. They control what we invest in non-current assets. Number 3, investment in working capital. Yes, they control all of those 3. Number 4, though, apportioned head office costs, apportion a share of head office costs. That they've no control over. They obviously, if they're in charge of a manager in charge of a division, obviously has no control over what costs are at head office, and so not number 4. So the answer is 1, 2, and 3. The answer's A. Uh, 15. Some numbers. What is the total relevant cost of material B for the special order? A company has received a special order for which it is considering the use of material B, which has been held in its inventory for some time. The inventory of 945 kilos was bought at £4.50 a kilo. The special order requires 1,500 kilos of B. If the inventory is not used for this order, it will be sold for £2.75 a kilo. The current price of material is £4.25. Well, it's a very, very standard question, relevant costs of materials. There should be no problem, apart obviously the time it takes to read, and there's a danger of making silly mistakes. However, we need 1,500 kilos. And where's it going to come from? Well, there is inventory of 945, so from inventory will be 945 kilos. If there's only 945 kilos in inventory, then the rest of it, with no choice, we're going to need to buy the remaining 555 kilo. And of course, if we actually have to buy those 555, the cost of that is no problem. The current price is £4.25, no argument. Those 555 will cost us in total 2358.75, I think. Check it again in a minute. The bit you need to be careful about or clear about is the amount that's coming from inventory. First of all, remember the fact it was bought for £4.50 is completely irrelevant. We've paid for that material. Whatever happens, it's a sunk cost. The question is, what would happen to the inventory if we didn't use it here? Well, if we don't use it in this order, it'll be sold for £2.75. And so if we have no other use for it, if we would otherwise sell it, then using it instead in this order is effectively costing us the lost revenue. It's an opportunity cost, but the word doesn't matter here. By using the order, we'd be losing £2.75 a kilo. 945 at 2.75 is 2598.75, and therefore the total relevant cost is 4957.5. The answer is A. And as I say, it's a very, very standard one. The material in inventory, if there's no other use, excuse me, the cost is the lost sales, lost revenue from it. On the other hand, if the inventory was in regular use, then we'd have to replace it. And for those 945, if it was in regular use, we'd have had to use 4.25 a kilo. But irrelevant here. Let's move on to number 16 now. Another numbers one. Sorry, trying to move the screen down. Here we go. For the total materials mix variance and total materials yield variance, was there a favourable or adverse result in September? So let's have a look. To produce 19 litres of product X, a standard input mix of 8 litres of chemical A and 12 litres of chemical B is required. So just let me jot bits down while I look at it. It's chemical A, sorry, so the standard mix, chemical A, 8 litres, chemical B, 12 litres. So we're putting a total of 20 in. It was to produce 19 litres, so presumably there's a loss, expected loss of 1, and therefore the yield, 19. So that's what should happen. During September, chemical A has a standard cost of 20 per litre. Chemical B, standard cost of 25. Anyway, that's standard. What actually happened, 1850 litres were produced. The output was 1850. There was a total input, 900 of A, 1100 of B. So we put in 2000 litres. We lost, therefore, 150. It was expected that an annual... it helped us even more. It was expected that an actual input of 2,000 litres would yield an output of 1,900 litres, 95%. The actual yield was only 1,850, which was 50 less than expected. Well, we didn't really need to be told that. We know the output is 1,850, it said so earlier. And also, we already know that we should lose 5%. You know, so we should have got 95% out. And they've told us the figure. So we should have got out, 1,900. We only got out 1,850. So immediately we know there's an adverse yield variance. We don't need to do any of the detailed arithmetic that you'd normally expect to do in a mix and yield. That should be immediately obvious from reading. However, what about the mix variance? For the mix variance, although we don't actually need to do all the numbers, rightly or wrongly, we input 2,000 litres. If we'd have mixed correctly, how should we have mixed? A should have been 8 out of every 20. So 8 out of every 20, you would have expected 800 of A out of 2,000. Whereas B should have been 12 litres for every 20. So for 2,000, it should have been 1,200. So what's happened here? This is what actually happened. And we've ended up buying more of X than we should have done. Oh, sorry, more of A, I beg your pardon. More of A than we should have done. And as a result, we've bought less of B. Now, it's a clever question, this. It's a nice question. It's testing your understanding rather than just being able to do the arithmetic. With a mixed variance, you're always buying more of one and less of the other. But as to whether that makes it more or less expensive than it should, depends on whether you're buying more or less of the cheaper and more or less of the more expensive. So what's happening here, we've bought less of B, which is the expensive one. As a result, we've bought more of A, which is the cheaper one. And if you've bought less of the expensive and more of the cheaper, you'll be saving money. As a result, the mix variance must be favourable. Now, I hope that made sense. As I say, you don't need all the numbers, and we certainly don't need to do any costings on it. It should be immediately obvious when you've read it that your yield variance is adverse. We've lost more than we should. I hope I've made the mix variance clear. We've actually bought more of the cheap, less of the expensive. So, which is the answer? The mix is favourable. The yield is adverse. The answer, therefore, is B. Number 17. Which of the above controls help to ensure the security of highly confidential information? Number 1, logical access controls. Yes. Controlling how people can access the system. It helps with security. Number 2, database controls. Similarly, you need controls over who can get in the database, how the database can be used. Number 3, hierarchical passwords. Yes. We don't really need to know what you mean by hierarchical. Any password system, it helps to ensure security. Hierarchical means, depending where you are in the organisation, your password lets you into different bits of the system. Number 4, range checks. No, all a range check is when you're entering something, maybe you've got to enter how many hours somebody worked in a day. Well, there's obviously a limit. Ultimately, a limit of 24 hours. Perhaps in our business, nobody works more than 10. So a range check would just be making sure that if you entered an impossible figure, if you entered 30 hours when the maximum it can be is 24, it wouldn't be accepted. So although that helps stop people entering incorrect data, it doesn't stop people getting into the system and reading information. So it's not a security measure. The answer is C. 18. Which components should the company buy in from outside in order to maximise its contribution? Let's read it. A business makes 2 components which it uses to produce one of its products. Details are, well, they told us the buy-in price, 14 and 17. They've told us the costs, materials, labour, variable overheads, fixed overheads, so the total absorption cost. Our job is to maximise contribution. Should we continue to make the components internally, make them ourselves, or should we buy from outside? The point is, we're not interested here in the fixed overheads. The variable costs in total for A, the variable costs are $12 a unit. For product B, 5, 11 and 7 is 18 a unit. The reason we're not interested in the fixed costs is that general fixed overheads, whatever they are in total, presumably we'll have to carry on paying whatever happens. We can charge them to each product any way we want, but I'm making up a figure here. If total fixed overheads are 20,000, well, it's going to be 20,000 whether we buy in or we don't buy in. That's why it's irrelevant. And so our real choice is component A, we can either make ourselves, and it'll be 12, or we can buy in, it'll be 14. Well, it's cheaper to make ourselves. Product B, we can either make ourselves and it costs 18, or we can buy in and it costs 17. Well, for product B, surely it's cheaper to buy in. And so product B will buy in, product A will make ourselves. Which component should we buy in from outside? Well, we just said it's B only. The answer is B. All right, on with question 19. In calculating the lifetime costs of the product, which of the above items would be excluded? And if we look back, the following costs arise in relation to production of a new product. Well, we don't even actually need to read them. I mean, the whole essence of lifetime costing or life cycle costing is that we take all of the costs over the life of the product and divide them by the number of units we expect to produce to get the life cycle cost. So it's all costs associated with the new product. So it is research and development, it is design, it is testing, it is advertising, it is production. We use all of them. It said which should be excluded. Well, none of them. D. Finally, number 20. What is the target cost for each unit of product X? The selling price of product X is set at $550 per unit. Sales for the coming year are expected to be 800 units. A return of 30% on the investment of 500,000 will be required in the coming year. You can get the same answer more than one way. I'm not going to argue. I'll do it the way I would. And then with target costing, we set the selling price first. Fine. We're given it. It's $550. We then work out what profit we require. It says a return of 30% is what we want on an investment of 500,000. So we want a profit of 150,000. Therefore, how much per unit profit do we need? 150,000 in total. We expect to sell 800 units. And so we need a profit of 187.50. And the target cost is whatever cost would give us a profit of 187.50 on a selling price of 550. So selling price 550, the profit we want 187.50, and therefore the target cost is 5182.96. I hope I've got my arithmetic right there. 362.50, I think. Is that one of the choices? Yes. D. So actually, I think a pretty easy one, or easy two actually, to finish on 19 and 20. Which is another reason why if any of the earlier ones were taking too long, or too long to read, or upsetting, or confusing, or whatever, you're best to leave them. Otherwise, the danger is you won't finish all 20. If you have time left at the end, then obviously you can go back, fill in any, or try again any that you got stuck on. Let me check. Anyway, there's section A. We'll carry on after with section B.